Good evening, everybody. All right, tonight we've got the great pleasure of having Jonathan Rose with us. Jonathan's kind of what you would call your professional trader. He's owned his own firms and helped run some firms, uh, consulted with hedge funds. So he's got some very unique trading techniques that I think you'll enjoy. So with that, Jonathan, welcome to the Candlestick Forum. We're anxious to see your information.
Thanks, Steve. Thank you for having me. I really appreciate it. Yeah, today we're going to be talking about bond trading. It looks like the Fed is getting ready to move or about to move. They moved once already. Just to kind of throw out there, does anybody, or kind of just throw in the chat box, who here trades fixed income, whether it's through the futures, ZF, ZB, ZN, the 10-year, the 30-year, or maybe the TLT, IEI, or the ETFs? Okay, a couple. 30-year, a lot of TLTs, TY and US. Okay, cool, a lot of TLTs and 30-year. Fantastic. Well, I think today I'm going to show you a new way to be able to look at the fixed income market. So let me start with just a basic risk disclaimer. Just read the first couple of lines. Trading or investing carries a high level of risk and is not suitable for all persons. Before deciding to trade or invest, you should carefully consider your investment objectives, level of experience, and ability to tolerate risk. So as we know, these are educational webinars. Whenever I talk about specific trades, it's just where I see value in the market. It's not a trade recommendation to any one person. So I appreciate Steve going over my background a little bit. I've been trading professionally for 18 years. That's all I've done. I've been a trader since I graduated school. I started out as a floor trader trading NASDAQ futures for about 5 years. Then I traded fixed income for 8, and then I was a market maker on the Chicago Board Options Exchange. Some highlights of my career: I've trained over 100 professional traders, specifically in this fixed income trade that I'm going to introduce to you. Then I was a market maker on the Chicago Board Options. When you're a market maker, you have to trade 100 names and 1,000 strikes simultaneously. So you really have to be comfortable valuing options. And then after that, I spent some time at a hedge fund. So let me just say, you made an awesome choice to attend today's completely free webinar. And here's why. I know what you're about to learn. I know the game-changing benefits of learning a fresh trade, a trade that none of my clients had ever seen before I introduced it to them. Like I've taught others before you, you're about to have one of those wow moments. So today I'm just going to teach you exactly how I trade bonds. And not only how I trade bonds, but the absolute correct way to trade bonds, the way the pros have been trading bonds for years. And here's the big idea. The bond market doesn't move without the Fed's direction. It's not like trading stocks. It's not like trading another commodity. The bond market really can't go anywhere until the Fed really tells it it can move. 2-year, 5-year bond futures, they're not going anywhere until the Fed starts to move. So the discussion of move rates is finally here. I actively traded these products when the Fed moved between 2003 and 2008. So I have direct experience, and that's what I'm going to share with you today. The benefits you'll get, or you'll see, it's consistent and trust in an approach that really works. The last time the Fed moved, I was able to take $8 million out of the market in 6 years. I was the director of trading for a 150-person trading shop in Chicago. I taught the traders this trade, and that's what I'm going to share with you today. We only have about an hour or so. I'll present for 30 minutes, 35 minutes, open it up for Q&A, and we'll go on from there. So everyone deals with the same issues in trading, me included. And I say this because I'm extremely close with my clients, and the underlying issues that we discuss are all very similar. Some getting close to retirement, just looking for that extra income source, or maybe frustrated with job security, making the right choice to invest in yourself, or maybe just frustrated trading the markets and you know there's a better way. Well, I'm here to tell you you're in the right place, but here's what I want you to do. Think about your trading and think about your biggest struggles in the market. These are the most common struggles that I see. Inconsistent performance, frustration with entry points and where to cover, clients moving 2 steps forward and then 3 steps back. You start getting some traction and then you get a big loss. And then an overall lack of confidence. Here's the hard part. In 3 to 6 months, consider if things don't change or maybe even gets worse. What happens then? Well, the good news is trading works. I can't emphasize this enough, but it's really important to be where the action is. We need to be in the right markets. And the right place to be right now, where volatility is going and where volume is going, is in the bond market. So if you can relate to this, you are certainly in the right place. At the end of this training, I'll show you where to get more. And more is going to be an accelerated process with advanced training. More will be everything you need to take this training to the next level. For some of you, this offer will make absolute sense, and that's great. I look forward to working with you. On the other hand, if advanced training is not for you, that's perfectly okay too. No hard feelings. So with that being said, let's get going. And I couldn't be more excited to show you exactly how this works. So here's what we're going to cover today. We're going to go through why we need to be ready when the Fed moves. I believe bond market is the most technical market in the world. I trade more off fundamentals and then I manage my trades with technicals. My clients have loved the technical side of the bond market. Then I'll introduce you to my bond trading bootcamp, how you could take action, set this up for yourself, and then we'll do a Q&A at the end. One last thing. I had a discussion with my members to gain an understanding as to what they thought about fixed income trading, what they thought about bond trading. And here's what I heard. Bonds are scary. It was a big boy trade. Maybe it's slow moving or boring. Let me be the one to tell you that's not real. People form assumptions, and assumptions trick us to being fact. Our minds are built to protect us. Bonds aren't scary. They're not only for hedge funds, and they are definitely not boring. Trading 5-year future contracts is no different than trading S&Ps, oil, Apple, Cisco, or anything else. Trading is trading, plain and simple. So how I got into fixed income trading. I moved to Chicago the day I graduated from undergraduate school, and I started trading NASDAQ futures. After my first year trading, I was up $1.5 million. I thought I was the man. I thought I was just destined to trade. But little did it had nothing to do with me. I was just in the right market at the right time. Here's when I traded NASDAQ. The green rectangle shows the time period. It was a great trade. Straight up, straight down. But at the end of that move, after being there for 5 years, volatility came out of the market and the trade was absolutely horrible. For 6 months, I couldn't make any money. And I didn't know what was going on. I was losing confidence. I was being hard on myself. I just couldn't figure it out. But here's what I learned. In good trades, anyone can make money. Being right out of school, I was able to make money. But in bad trades, the best are lucky if they break even, and the worst are going to go out of business. That's when I learned the biggest lesson of my career. When a trade dies, you really need to move on. And that's when I moved on to trading fixed income. I moved to trading fixed income June of '03 when the Fed was raising. They moved from 1% to 5.25%. It was a 425 basis point rise in 36 months. And what did they do in June '06? About face. They went from 5.25 down to 1/4, a 525 bip lowering in 31 months. Now, I was trading so many fixed income contracts at the time that the Chicago Mercantile Exchange was flying me all around to their best events. Looks like there's a little lag in my presentation. Just pictures on the left playing with the LPGA pros, on the right playing with Tiki Barber over at Baltusrol Country Clubs. We were trading so many fixed income contracts at the time, the Mercantile Exchange was hosting us all over. What I want you to see is when the Fed lowered 2.5 years, look at that chart and look how fast the bonds moved up. It is a one-way trade. This whole move right here, this is over a 7 or 8 month period of just no pullbacks whatsoever. And I think this is what we're going to be facing as well. Once the Fed starts moving, it becomes a very predictable trade. When the Fed was done moving, it dried up, just like the NASDAQ did, but this time I wasn't going to get caught in a bad trade. Options were having exponential growth, and that's when I decided to be a market maker on the floor of the Chicago Board Options Exchange. The reason I take you through my background is for one important point. Good markets are 10 times easier to trade than bad markets. Plain and simple. I see a couple of questions coming through. Let me get through the PowerPoint, some examples, and then we'll go over all the questions. But let's get into the bond trading. CME, someone's asking CBOT. Chicago Board Options, Chicago Mercantile Exchange was where I traded NASDAQ futures. When I traded bonds, I traded them electronically. So who thinks the Fed's going to raise in June? Seems like they're getting pretty close. I imagine tomorrow's data is going to be pretty dependent. Nope, a lot of no's. No rise. It's pretty close. They seem like quite a bit of pressure. If not June, I agree. I still think that they're going to raise 2 more times before the end of the year. But all this uncertainty is still going to give us volatility in the markets. So bond trading. This is important. You probably know. When interest rates go higher, bond prices are going to go lower. When interest rates go lower, bond prices are going higher. Why that happens? We don't need to know why it happens for the trade. I'll explain why it happens, but you don't need to know. Let's say I buy our face bond, a 30-year bond, and I get 3% on it. Yippee, I get 3% for 30 years. In this example, let's say 30 years shoots up to 10%. The next guy who buys the same bond is going to get 10%. How would I ever get rid of my 3% bond? The only way I can get rid of my bond where I'm only getting 3% is I have to sell it for a big discount. So if rates go higher, maybe I can sell my bond for $300. Whoever buys that gets my 3% for 30 years, but that bond also matures at $1,000, so that's how they're making up the rest of their return. The last 2.5 years. Earlier I said 5-year future contracts can't go anywhere without the Fed moving, without the Fed telling them exactly where they can go. This is what the 5-year future contract chart looks like going back 2.5 years. Nice, simple discipline. When it gets to the top of its range, we're looking to sell it. When it gets to the bottom of the range, we're looking to buy it. Very straightforward when the Fed's not moving. When the Fed is moving, it's a one-way trade. I really believe if we prepare now, we're going to see one of the most straightforward trades of our lifetime. Here's how my style is different. I've consulted with hedge funds and a major family office in Chicago about this very trade. Here's what I really want you to understand. The information I share with you on bonds is not available anywhere else. You're about to be exposed to a completely different way of seeing the market. And I don't say this to boast, but I've seen other educators' information on bonds, and I don't think that they're covering the entire story. So bond trading. The main difference between stocks and bonds is that bonds are going to be a puzzle, and we need to learn to put that puzzle together. In stocks, we might play breakouts, might follow different charting patterns, but when you're trading bonds, it's going to be a relationship type of trade. And let me explain. And I'm going to explain by being a little analogous, just because I think taking a step away from bonds is helpful in understanding. So let's do the example using diamonds. And I don't know anything about diamonds, but it seems like this is a good way to start. Everyone in this room, we're all going to a flea market together. And these are what the prices of diamonds are trading for. 1 carat diamonds are trading for $1,000. 2 carat, $2,000, 1,000, 4 carat, $4,000. Those are the prices that we see for diamonds. After 5 hours or so of hanging out, the prices start to move. And we see the bigger diamonds have doubled in price. The 4 carats are now $8,000. The 3 carats are now $4,000. The 2 carats are $3,000, but the 1 carats haven't moved at all. Now, if we were investing in diamonds and we held a bunch of these 4 carat stones, probably want to sell them. We just doubled our money, and maybe we'd want to buy some 1 carat. They haven't really moved. Or what happens if somebody comes in and needs to buy all the 2 carat diamonds at this flea market? 2 carats are going to be more expensive than 3 carat for a given time period. It's not sustainable. They're not going to stay more expensive, but in that time period, they can get more expensive just based upon pure supply and demand. This is the thinking to go with fixed income. Talking about diamonds, we're talking about notes and bonds. And that's it. So the way the trade works is we're not just trading fixed income. We're not only looking at the ZB. What we're doing, so the ZB would be here. What we're doing is we're looking at all these points on the curve in order to value bonds. Now the front end of the yield curve, all this stuff up here, these are all Eurodollar contracts. We're not talking about Eurodollar contracts. What we are talking about is the future contracts, and then also there's an ETF that replicates each of these future contracts. So we're going to be looking at the ZT, which is a 2-year. The ZF is going to be a 5-year. The ZN, a 10-year. ZB, 30-year. And UB is called the Ultra Bond. Here's what a lot of people don't really understand about bonds. The ZB that I noticed a bunch of people are trading, the ZB, it's a 30-year future, but if you look under the hood, the ZB is really an 18-year bond. The 10-year future contract, that's really a 7-year. The 5 years closer to a 4-year. So what we're doing is we're just looking at the relationship. If we think about diamonds, if we know the difference between 1 carat and 4 carat, we can back into the difference between 2s and 3s, 1s and 2s, 2s and 4s, 3s and 4s. And so that's how we're looking at the market. So a lot of people say, once the Fed starts raising rates, aren't all bonds going to come off? Well, yeah, they are. But what we want to do is we want to find the most expensive one. We want to find the one that hasn't come off as much as the others. Maybe the ZB is way offered, but the ZN, the 10-year, hasn't started to really make a move yet. Or the ZF hasn't really started to make a move yet. So what we want to do is we want to make good decisions within the fixed income market. This chart is showing the difference between 5-year future contracts and 10-year future contracts. It's a relationship trade. They're highly correlated. And what we do with this kind of trade is when it gets expensive, we just look to sell it. And when it gets inexpensive, we look very, very straightforward, It's a different kind of trading than most people are exposed to. But if you think about it, you could trade the 30-year bond, or you could trade a stock and guess whether it's going to go up or whether it's going to go down. What we're doing here is looking at the relationship between 5-year and 10-year, which is really 5-year and 7-year. So it's just a real little piece that sometimes gets out of whack because of supply and demand. Rick is saying there's a lot of echo coming through. Sometimes these get out of whack because supply and demand, but they inevitably come back together. So think about this like a rubber band. If a rubber band gets pulled really far, it's inevitably going to come back. And that's what this trade is like. I'm going to get in, open up my charts, and we'll go through some examples. So hopefully everybody can see this. Oh, good. So it sounds like the sound's okay. So hopefully everyone can see the chart. Now, the way I teach bonds, I have a 7- and 9-year-old boy, so I often talk in video game speak quite a bit. So the way that we teach bonds is level 1, level 2, and level 3. Level 1 is going to be the most basic, which is going to be more outright trading. That's when we just look at the 2-year, the 5-year, the 10-year. So if we're just going to look at the outright charts, that's going to be ZF. And this is what the ZF looks like. And again, going back to 2013, it's just very straightforward. We were big sellers of ZF contracts when they got up to the top of their range, and then we patiently wait for them to come off. The way we do these trades is we look to ladder into them. If I'm doing a 10 lot, I'll look to sell 3, sell 3, sell 3, but I always want to hold a core position, which means sell 3, sell 3, sell 3, and then I might buy 3 back, buy 3 back, and then buy 3 lower. If it bounces, we'll look to get in again. So that's how we're going to look at trading the outright contracts. Level 2 is going to be when we start looking at the spreads. So this spread is going to be the 2-year against the 5-year. And get it off a weekly, because that's not going to be very helpful. I'm getting a lot of people saying they're having trouble reading the charts. The charts are just, that's going to be more based on the connection, I'm thinking. Okay, so let me continue. I'm going to talk it through. If you're having trouble seeing the charts, we're just going to stay on these for a little bit. So this is going to be an example of a 2-year and 5-year. And here you can see going back for 2 weeks, or hopefully you can see, it's just a range trade. When they get extended, we're looking to rally. When they get high, they're looking to sell off. And that's how this trade works. This is 2s, 5s. Very, very simplistic, very, very straightforward. Right now we're long 2s, 5s. I'm just going to do one more chart and then we'll get off and go to the PowerPoint because it seems like that's we're getting a better connection on that. The other trade that we look at, this is the bond trade. Bonds against UV. That's just the difference between the 30-year future contract and the ultra future contract. This one, for those with screens open, you can just do ZB minus UB. The ratio is 1-to-1. There's going to be ratios on all these trades. The ratios are given out by the Chicago Mercantile Exchange. If you go on the Chicago Mercantile Exchange site and look up how to trade bonds, you're going to get 100-page white papers about this exact trade. This is how to trade bonds. This is how the Merc wants you to trade bonds, and this is what we teach. Jim, the chart that I was showing before was a 2-year against a 5-year. That's correct. We're looking at, level 2 is going to be looking at these different pairs. 2s, 5s, 5 10s, 10s bonds, bonds ultra. Level 3 is going to get, we're going to look at the entire yield curve. And the way we do that is we look at 2s, 30s. And that's what 2s, 30s look like. In this last couple of weeks, the whole yield curve has been getting destroyed, which means the 2-year and the 30-year are getting closer together in value because the 2 years going higher and the 30 years not really moving. I am long the yield curve. I'm going to get off these charts because it seems like a lot of people are having trouble seeing them. So yeah, Taz, ZT against ZF, but you're going to need a ratio in there. And when we're doing a spread, we're looking to, if you're looking to buy a spread, you're buying the front and selling the back. If you're looking to sell it, you're selling the front and buying the back. And obviously this is coming off confusing, but it's really, really straightforward. So let me go back to the PowerPoint. Okay, so this seems like everybody can see this one better. Goldman Sachs still thinks the Fed's going to raise 3 more times before the end of the year. They think rates are going to move 4 times before the end of next year. That would put the 2-year up at 2.25. The last time rates were there, this is what the yield curve, that's the difference to be for what it is now. And the great thing about the bond trade, it's not that we're guessing which way it's going to go. We know where it's going to go. We just have to learn how to manage money in order to get there. Where people have trouble with this trade is they don't have the discipline to stay on the edges. They can't wait until it gets really inexpensive to buy and wait till it gets really expensive to sell. Instead, they want to be more transactional, and that's not how the trade works. Let's be disciplined. Let's have our levels where we're willing to trade, and then you make a trade. You don't want to force it. You don't want to chase these trades. So again, once in a decade opportunity. I really think it's going to start in June. Once they start moving, the time to learn is going to be in the past. The market rewards those who move quickly. So I'm sorry about the charting, but I always like to ask this because if my answer is no, I feel like my message isn't getting across. And it doesn't have to be with me, but can you see the power of really being in the right markets, seeing where volume is moving towards? Because that's what's always key. And that's why I got super lucky falling into the NASDAQ during that crazy volatility. Jim, thank you. And then moving to fixed income, and then moving to options. You always want to be in the markets that are really growing, where the money is going into. Yes, CME gives the correct ratios. Taz, I got you. I'll give you everything you need. Just to be clear, none of this is theory. This is all stuff that I've used in the markets to make millions. Here's one of my clients, James. James moved forward with the boot camp the day I introduced it to my community. With no prior fixed income experience, he's developing confidence in the trade for consistent returns. So with that being said, I take great pride in introducing my bond trading boot camp. Here, I've created the ultimate resource for you to trade bonds and prepare for the Fed. Again, this is a proven method I've used with over 100 professional traders. This boot camp is everything you need for big results when the Fed moves. Here's the benefit you'll get from trading bonds. it's consistent, and it's a brand new source of profits that's not correlated to whatever you're presently doing. Now, I want to go over exactly what's included and exactly what you're going to learn. Let me say, and I know a lot of people are unfamiliar with me here, I've never done a workshop that's longer than 2 hours. I don't filibuster, there's no BS. This boot camp is 3 hours of on-demand content that's yours to watch immediately. So here's what's included. First, we go over what should you trade. The 2-year, 5-year, 10-year bonds, they have different personalities. When I trade options, I am extremely patient. When I trade futures, I'm not patient at all. I don't know why. I don't fight it. I just know that I'm not patient trading futures. So for me, I like to trade the fast stuff. I want to trade ZB, UB, ZN. For those that are more patient, ZT, ZF, the 2-year, the 5-year are a better trade. So that's the first thing we do, is we go over the personality of the trades. Then we go over the yield curve. I introduce you to a puzzle. We cover futures, that level 1. Then we do level 2 with spreads, and level 3 following the entire yield curve. Then I show you how to replicate this trade with ETFs, and then we also get into options. The only really liquid options that you can trade is TLT. IEI, IEF, they're good ETFs, but they don't have really great options. I want to share the experience of Mike, because I bet a ton of you can relate to his situation. Mike's eager to learn. He knows he's close, but really wanted to get over a major hump in his trading. So Mike reached out to me. Mike spent a ton of money on training only to be disappointed. And that stinks. I would feel the exact same way. After working with each other for a month and a half, he moved forward with one of my courses, and he calls it the best course that he's ever taken. So here's what you get. 3 hours of on-demand content, bond trading bootcamp for futures, stocks, and options. I also include easy-to-read bond specs that you can keep next to your computer that gives you margin information, what's actually in the futures, tick value, all that. 2 different times in the Chicago area, I've gotten over $5,000 for consulting on this very trade. You may be thinking, what if I've never traded futures? And for that, if you're trading Apple, there's not going to be a difference if you go and start trading Microsoft. The key is once your account is set up, trading is trading. It doesn't matter if you're at that flea market or trading fixed income. Times have changed. For the first time in history, we can learn without risking any money. But we need to invest in ourselves. So here's what I would do. Open up Thinkorswim or Interactive Brokers and paper trade. Everyone who gets into this trade, because it's so new, I'm going to ask you to paper trade. Build confidence. Get your memory filled with different situations. Prove to yourself that you can make it work, and then get in there with real money. Here's Lars. Lars used to trade bonds, but stopped because he was frustrated and couldn't make money. He was only trading the ZB. I told him that doesn't really work. It's very difficult just to trade one point of the yield curve. Once he learned to use the rest of fixed income profits, he got it and was off to the races. So here's what you get. Bond Trading Bootcamp. 3 hours on-demand class plus the bond specs spreadsheet. I'm also including a special bonus that I'm going to introduce on the next slide. Retail, not sure what it retails for because it's not really out there. And we're going to do this for $297. And I want to make this as affordable as possible for everyone. The bonus that we're going to add, Jennifer's asking the trading hours. Great question. The trading hours for this stuff, it's really 23 hours a day. It takes off on Friday, 4 o'clock, it'll close, and just close for the weekend. Open Sunday night, but because bonds are such a global trade, a lot of my clients will trade it for a couple of hours before the opening. When Europe opens, when China opens, the bond market's busy. we're also doing a bonus. I'm a big believer in trading, and for that matter in life, if you're frustrated or something's not working out, we need to change. So for your benefit, I'm adding a special bonus, but we're going to do this bonus for anyone who knows this feels right now. So for anyone who signs up while we're live, you're also going to receive a bonus on managing your futures position. This is a separate workshop which shares a step-by-step process to manage these trades. The workshop covers money management, position management, and also includes exercises for you to do while you're paper trading, but we're going to move forward while we're live today. Why I have a live bonus? 2 reasons. Those who take decisive action get the best results. And just like the markets, there's edge to those who move fast, and that I want to reward those as well. So we'll get to the questions, but I just want to make it clear, I'm not a gifted trader at all. I don't have any special information. What I do have is I have an approach that works, and through my experience, I know when the right time is to trade these markets. I haven't been trading the markets in fixed income from 2008 to 2011. Then I started range trading the 5-year future contract, just keeping it simple. But now volatility is going higher and the Fed's starting to move, so it's time to trade bonds. Another client, another great result, just learning to trade fixed income contracts. So now I'm going to open it up to any questions. These are the most frequently asked questions, which I'll go through as well. But first, I'll go through your questions. So Taz is asking, how do you type these ratios into Thinkorswim? You can do it a couple of different ways. You can either do it through Thinkorswim's pair trader, or you can do it just in any old chart. If you're going to do it in any chart, you could do /ZT. I'll put it in the chat if that works. /ZT times 4 minus /ZF times 3. So that's just saying 4ZT to 3ZF. So in this example, so Chuck, what I just put out there, if I wanted to buy that spread, I would be buying the 2-year and selling the 5-year. Buying 4ZT and selling 3ZF. I'm happy to go through examples on the chart as long as everyone can see. Yeah. So we got the chart up again. Chuck, I do those trades too. If you like cattle, hogs, so Chuck says he's used to spreading corn versus wheat, cattle, hogs. I trade the crush. I trade the soybeans, corn. All these kind of trades, fixed income, it's the same kind of thing. And along with those, once we get more comfortable, then we start looking at different butterflies, where we're looking at the ZN against the ZF and against the ZB. So that's a great question. So RB says, there's so much speculation about the Fed. Do you wait to the Fed to move for this trade? Absolutely. This trade is going on right now. This trade has been, ZB minus UB has been such a reliable trade. That's what it looks like. I'm long ZB UB. But what we do is once the range sets, we're buyers, we're sellers, and again, we're laddering into these trades. So we'll do it 1, 1, 1. And then when it pops up, we'll sell 1. We'll look to trade from one side. When it gets down here, we're only looking to buy this spread. Buy ZB, sell UB. Jennifer, this is not bonds versus stocks. This is 2-year, 5-year, 10-year, 30-year bonds. This is interesting. For those who trade ZB or TLT, let me just put this on a more presentable format here. So in front of you is just an hourly of the 30-year futures contract. If I do a comparison, I'm going to do it with the TLT just to show you how close they are. So comparison, TLT, okay, apply, okay. So let's put this on a longer term chart. So what you see there is just bonds over TLT. It's the same thing. Oh, I'm sorry, Jennifer, that's not your question. So I'm sorry, not sure how to pronounce your name or if that's your name. Bond ETFs. Here you go. Here are bond specs, and the bond ETFs are going to be the SHY, SHY, that's going to be the 2-year, IEI, IEF, and TLT. John, this could be traded on Infinity Futures, Interactive Brokers, Thinkorswim, lots of different platforms. So you can see in the trade station as well, for sure, for sure. Especially, so Thinkorswim has a pair trader. I use the pair trader in order to set up the charts. Options House, as long as they trade futures. I'm not sure if Options House trades futures. I'm not very familiar with the product, even though I used to work at the hedge fund that owned them. The front end of the curve, the 2-year and 5-year, is going to be less margin. So we always get margin questions. I would say a $5,000 account would be good for the front end, ZTZF. And then for the entire curve, you're probably going to want a $15,000 account minimum. But again, this is such a cool trade to paper trade and to learn. I mean, for the price to be able to learn this kind of trade, because 5 years ago, the only way to learn this trade is a professional proprietary shop. And now that all these different platforms allow you to trade futures and pairs, we can now. That's why you don't see this trade presented anywhere else. Absolutely. So in the boot camp, we go through the TOS pair trader, but we also go through how to chart these spreads just by putting them into the formula box. And that's very straightforward. I haven't had one question from anybody who's had trouble charting these. Actually, that's not true. I have 2 clients in Italy that moved forward with this, and we had to find a solution for them. That was the only issues that we've had with charting. Jennifer, I didn't get your question then. I'm sorry. Yeah. So there you have it. The Bond Trading Bootcamp, 3 hours on demand plus bond spec sheet. I'm extremely accessible. I'd like to put my personal email in the chat box as well, because moving forward with any of my products, you get full access to me, and I need this to work for you in order for it to work for me. We also, thank you, Dave. I've gotten a lot of compliments on that, about the pricing of it as well, to try to keep it down to, a reasonable price, because I just think this trade is so great. On demand does mean the video is available to you. Watch it as many times as you want. You own it. So Diane is asking, Are you saying bonds are going up or down when interest rates go up? So when interest rates go up, the prices are going down. What I want everyone to understand too is I don't speculate. I never speculate. So I want to trade fixed income. I want to trade the relationship between those different instruments. And if you think about the yield curve and you think about once in a while it'll have a kink in it, we're just flattening out those kinks. Back to that diamond example, if 2-year diamonds are priced more than 3-year diamonds, we're probably going to look to buy 3-year diamonds. Inevitably, they seem like they're going to come back to, to some semblance of value. So that's more of how I look at this trade. I am no way saying this is where bonds are going to go. Let's speculate. Let's just sell futures and sit on our hands and not do anything. I want to trade the relationship between those futures, because once things really start moving and they start moving fast, it gets off value. And that's what professionals do. They come in and revalue these things, and that's exactly what we're going to be teaching in the bond trading bootcamp. So yeah, it's not speculating at all. John, working during the day, these are, I would classify them as swing trades. About working your level. Once those levels present, then getting in and making good trades. So it's not an active roll up your sleeves. You have to be trading all day. Set your levels. Let's be comfortable with those levels. And then if they trade, they trade. Gotcha. Okay, Jennifer, I got it. So Jennifer's saying stocks, there's so many different stocks to trade, too many choices. Bonds, how many choices? Well, in this trade, there's going to be 2-year, 5-year, 10-year, 30-year, and ultra. So 5. 5 trades. And that's what we're looking to do. We're just looking to value them against one another. TZ on the floor, I was JDR. My middle name's David. That's why. Were you on the floor as well? So, all right, it looks like we got through all the questions. For those who move forward, I'm excited to work with you. If you have any additional questions, feel free to email me. Once again, I put my email up, and that's it. Thank you for having me, Steve. I really appreciate you having me, and I hope it was beneficial to you guys.
Thank you, Jonathan. Very good stuff. Everybody, definitely take a look at Jonathan's information. Again, everybody has their trading styles, and you want to figure out what works the best for you. So, as you can see, Jonathan isn't a speculator. He just works off of relationships. So with that, Jonathan, great information. Thank you for presenting tonight. And with that, everybody, we'll see you in the chat rooms.
Great. Thanks again, Steve. Thank you, everyone.